Okay, good afternoon, everyone, and welcome to our training. Today's training, we're going to be looking at swing trading, so the ultimate swing trading masterclass. And then we're going to break down the system of trading so that we can, you can decide if that is something if that's something you want to do. Okay. Sorry about that. So quickly, disclaimer, you need to understand that there's risk in trading and that you want to ensure that you're trading with risk capital only. This information is for educational purposes only. You want to make sure you make solid investment advice based on your own decision. I'm going to be your host as usual. My name is Nnanna Alexander. I'm the senior market analyst at Ivy Markets. I'm a pro trader, and I'm going to be your host for this training because I handle lots of this. Okay, so today we're going to be looking at swing trading, like I mentioned earlier. And there are three main things we'll really talk about today. We'll look at swing trading. So I'll define what swing trading is, kind of explain it. And then we'll look at the pros and cons of swing trading. So why should you choose swing trading? What are the advantages or disadvantages? And then so you can be able to decide if it's a good fit for you. And then we'll now wrap up with the different strategies, well, not necessarily strategies, but the different approach to swing trading and what swing traders necessarily look out for in terms of trying to get into a market or get into a trade. Okay, so let's jump right into it, swing trading. Now, swing trading, obviously, I get this line. So swing trading refers to a style of trading where traders try to profit from the swings in the market. So remember, the market tends to move in swings. So by swings, I mean, move in a particular direction, trade in, retrace, it keeps moving from different swings in the market. So as swing traders, we try to profit from these price swings in the markets, right? Now, when I'm looking at the difference between swing trader or the pros and cons, swing trading and day trading, you'd see the difference. But when it comes to swing traders, basically, they're working with higher time frames. So as a swing trader, usually you're working with a daily chart. So you're making trading decisions based on this price movement on the daily chart. So obviously, if you're using a daily chart as your basis, then it means you're definitely going to see less and less trades, right? Now, swing trading is a style, because of that fact, it requires patience because, well, it takes a day for a candle to form. So before you see a pattern or before you see this movement in the market, it does require sufficient time in the market. So it does have its advantage, it does have its disadvantage. We'll discuss that shortly. As swing traders, what we try to do is identify the trends in the market. So you want to look at the market, from a bigger time frame, like the daily chart or the weekly chart, and then you're trying to identify the direction of the trend. So where is the market going? And then you want to play that trend. So you want to trade the market in that direction of where you think price is going. So because of this, it means you're probably holding a trade anything between 2 days or several weeks. So you can be holding a trade for weeks, or you can be holding a trade for days, right? Because you're using the daily chart to do your analysis. So it's obviously going to take much longer for price to get to destination and then for price to negate your trade. So this is the reason why swing traders tend to hold trade much more. Unlike day traders, we're looking to get in at the market, trading with like 1 hour charts or the 15-minute charts. But looking to get in and out of the market, at least that same day, you want to open a position and close the position, take more profit, get out of the market before the end of the day. Maximum maybe 2 days or maximum 3 days you're holding the trade. As a swing trader, you're probably looking to hold the trade for several days, even weeks, depending on the setup. Okay, so swing trading is actually ideal for people who, if you think about it, right? Because if you're analyzing your charts based on the 1 hour charts, right? There are 24 hours in a day. That means in every trading day, 24 candles is formed. If you're looking at the setup, maybe you're looking to see if price wants to test the trend line or maybe you test the support or resistance area. You have to watch it can happen this hour, it can happen in the next 4 hours, it can happen in the next, So you're going to have to monitor the chart more often if you're trading on a lower time frame or if you're day trading. For swing trading, because you're using at least the daily time frame, and you probably maybe the 4 hours, but mostly at least the daily time frame, it takes a full day for a candle to form. That means you can just probably do your analysis early in the late at night when the candle, when it takes one day. So when the candle has closed, you can see the setup of the markets where the candle closed for the day, deciding whether you want to take a trade or whether it has your criteria has been met or not. I hope this concept is clear. Now, swing trading is who does it fit? It is best suited for people who so you don't want to spend so much time looking at the charts. You don't want to be looking at the charts so often. You don't want to be analyzing every single candle, or 15-minute trading, 15-minute time frame or something like that. So it is best suited for people who maybe have a full-time job and just understand enough of their market analysis and then want to be able to want to be able to trade the swings in the market. So you're not paying attention to the intraday noises in the market. You're paying attention to the swings in the market. Now, this is very favorable to people like this who either maybe don't want to spend all time on the charts or maybe have a full-time job. Now, the other side of it is, well, if you think about it, if you're trading based on the daily time frame, obviously your stop loss will be much bigger, right? So don't worry, we'll come to that when we look at the pros and the cons. Now, swing trading, swing traders, you were technically basically looking at analyzing the market, a little bit more long term, to figure out where price is going and how we trade it. So you can apply maybe fundamental or technical analysis in order to determine if price is going up or coming down in the near future. So within the next, in the near future, you're looking at where is price going? How do I profit from price movements in that direction? You're looking at the next couple of days, maybe the next couple of weeks. A day trader is looking at the next couple of hours, maybe the next couple of minutes. Now, swing traders, what we tend to do is tend to identify the highs, the swings, right? The swings in the market in maybe medium term, maybe quite a little bit long-term trade. So we're looking at medium-term trades, right? So swing traders are looking for medium-term trade opportunities, those swings in the market where price gets to, a mid-low or a high, and you're looking to trade the swing in the market, trying to get the best possible probability of winning. Now, just like I was mentioning, since you're looking to take a trade for hold a trade for, you're analyzing the market based on the daily charts, sometimes the weekly charts. Well, it means that your stop losses would be wider, right? So for example, if you see a pin bar on the 1 hour chart and you're looking to trade that pin bar on the 1 hour chart, right? Let's say it's a bullish pin bar, right? And you see that bullish pin bar on the 1 hour chart. Now, if you're looking to buy the market because of that price structure, your stop loss would come maybe below the low of that pin bar, right? And then your take profits, well, maybe the next key level. Now, if it's a 1 hour chart, the pip difference, the distance, like the number of pips between your entry and your exit, would not be so much because, well, it's a 1 hour chart. So you might be looking at maybe a 30 pips stop loss, 20 pips, 50 pips stop loss. Or if you're looking at a daily chart, right? And you're looking to trade the pin bar on a daily chart. In the same idea, your stop loss will still go, let's say it's a bullish pin bar, your stop loss would also still go below the low of the candle. And you target, you place your target based on the next, maybe the next key level. But your stop loss will be wider because, well, in a daily candle, is much bigger. The volume in a daily candle is much bigger, right? So a daily candle might be like 110 pips or 80 pips or 90 pips. While a 1 hour candle, your stop loss will be like 20 pips or 30 pips. So it means if you take a loss in a swing trade, if you're trading a swing trade, your stop loss will be much larger. Obviously, you know that your potential profits would also be larger, right? So in a swing trade, when we're looking to swing trade in the markets, then you're going to have to, it requires a little bit more. You need to manage your profits. You need to have proper money management plan and use proper risk management. Obviously, you need to do this in all setup, whether you're a swing trader or a day trader. Well, in a swing trade, the losses are much larger. Obviously, your profits are also much larger. The good thing is it gives you more room to and less involvement in the market, which is actually quite good. Well, good that we'll see that as well. Now, this is one of those things that is, swing trading is one of those things that, like everything in life, has pros and cons. So let's look at that. What are the pros and cons of swing trading as opposed to like day trading? Now, the pros, the advantage, it requires less time to trade, right? If you're a swing trader, basically, personally, I trade about 28 currency pairs, right? I don't about just around 28 currency pairs. So if you add gold to maybe like 29, uh, so if you're swing trading, you can analyze 28 currency pairs. You know, you just need at the end of the day, you can just use a couple of minutes, maybe 30 minutes or 1 hour to do your analysis, look at the price pattern of all of those charts and make your decision. Because you're looking at the daily chart, so it takes 1 day for the candle to form, right? Now, unlike, let's say you're day trading, if you're day trading and you're trading maybe the 1 hour charts, you know, if you don't pay attention to the markets, a trade setup might play out, and before you come back, the trade has either moved, right? Or the trade has materialized, the trade you could probably have taken has played out and has gone. And so you need to stay on your chart more often if you're day trading. So in a swing trader, you need less time to analyze the market, less time so this gives you room to do all other things, right? Now, it's another advantage of swing trading is that it looks to help to maximize short-term profits in capturing bulk of the market swing. So when we go to the chart, I'll kind of explain that for you. So what it means basically is what we're looking to do as swing traders is we're looking to capture the big moves in the market. So you can have a profit target of like 300 pips, 400 pips move in the market because you're playing the swing, right? You're using the higher time frame to trade the swing of this market, right? So you're going to maximize your profit potential and you capture big moves in the market. So look at this, right? It depending on the kind of person you are, the kind of trader you want to be, it might be a pro or a con. So as a swing trader, you trade less, you will not trade more. You not be able to not take plenty trades. So you probably take a couple of trades, maybe 2, 3, maximum maybe 5 trades in a week that you take. And unlike a day trader where you might take up to like 5 trades in a day, right? Now, as a swing trader, you're taking less trades. Now, obviously, you're taking less trades. But the thing here is your profit potential is much bigger. So you're capturing more pips when price goes in your favor, and then obviously you need to limit your risk. Obviously, you lose more. But let's say, for example, you take a loss on a swing trade. The loss may not happen instantly. So you might take a couple of days and that happens. But as a day trader, if you take several losses, you can take several losses in a day. Right? Obviously, maybe small 20 pips, 30 pips, and they can compile and be big. So what is important is what works for you, right? So if you have more time in your hand and you like looking at the chart and analyzing and making decisions, look to day trade. If you're looking to just strategically analyze the market and get in and out at good positions, or obviously in every situation you're looking to get in and out at good position, but if you're looking to trade less, look for big moves in the market or swings in the market, obviously you need to understand that you definitely take losses. So your losses will be bigger, so you want to ensure you're using the bigger capital. So if you're swing trading, you probably want to use if it's more substantial capital, maybe like $500. Obviously, you can try that in every account size, but I just feel that's maybe. So, and then the third point here is, as a swing trader, you can rely exclusively on technical analysis, like simplify the process, just looking at the charts, making trading decisions based on what the price pattern is doing, using a daily chart to look at it. So all of those market news and noises in the markets, you don't really pay attention to them because they happen intraday. And so, at the end of the day, when you're looking, you see the overall structure of the market as opposed to somebody who's looking at the 1 hour chart or the 15-minute chart. The moves will just be a lot erratic. Now, the cons of swing trading is, well, you have to hold positions overnight, sometimes even over the weekend. And there's something called swap. So you pay swap if you're holding positions overnight. Small fees, obviously. And so those are some of the disadvantages of swing trading because you have to hold positions, long trade positions, and you'll be accumulating some swaps. And then another one is the market could abruptly reverse, and then your losses, obviously, because your stop losses are bigger, your losses can be bigger if you're swing trading. And then let us look at the three swing trading strategies that I want to talk about. So when it comes to swing trading, traders tend to focus on high probability areas, right? So you understand the market structure and you're trying to play the movement in the markets, right? So we're going to the three main systems swing trader look out for, like that I want that personally that I'll discuss about here is the reversal, retracement, and the breakout trading. So I'll just use a slide to kind of explain each of this. And then we'll go to the chart and look at, probably we can see some examples of this as well. So the first one we'll talk about is the retracement trading. So in retracement trading, it actually involves looking for price to temporarily reverse within a larger trend, right? So what I mean is this: if you look at this chart here, you can see prices, right? This trend is bullish, right? The price is going up, trend is bullish. So as in retracement trading, you are looking at this is the overall trend of the market, bullish, but looking to play the move. So you know that the price will retrace. You're looking for where it will form this low and you buy. Now, pay attention. You can also have this chart to be a 1 hour chart, but as a swing trader, you're looking at least daily charts, right? So this is a daily chart. So that means this move from here to here could be several weeks. The move from here to here could be several weeks, maybe a month or something like that. So as a swing trader, you're looking to play the swing. So the market is bullish. You're looking to, buy low at this swing. Obviously, the inverse would be if the market was bearish as well. So as swing traders, we're looking for these opportunities to buy the market at these low prices here by the continuation of the market. So now, the same strategies you use for your decision as to whether you want to enter a trade or exit a trade, it's quite similar to what you use if you're doing your 1 hour chart or 1 hour analysis. Or remember what I tell you, what I teach is that the system you learn works on every time frame. So it's the same. You still be looking for counter trend line breaks, price action from this level of support, or other kind of structure break that shows you price continue movement. But the thing with the swing trader is this is like a daily chart, and you're looking to buy this swing low, and then you're looking to trace the markets up high. So this move here, if you play the move, would give you nice hands-on profits. You understand where you should place your stop loss in case the market negates you and all. And so as long as the market is still respecting this bullish setup, you're looking to buy these swings. You're looking to, these are what we call swings, right? So this is a swing, swing 1, swing 2, swing 3, swing 4, swing 5, swing 6. So this could be a couple of bullish, bearish, bullish, bearish, bullish, 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 bullish candles set up. Then, this retracement where the market is retracing here, you're looking to, when the market does retrace, you're looking to buy the market back up. So that is the first style. The second one is actually the reversal trading. So in the reversal trading, say prices, just like in the retracement setup as well, price is actually bullish, right? So let's still use this example. So we have in reversal, we're looking to a change in direction. In the previous example, prices, we are certainly buying those reversal points, those continuations. So when the market is reversing, we buy the continuation of the overall trend. When the reversal is just like we know, no trend continues forever. So what we're looking out for as the other style is you're obviously playing all the setups. So for example, I'm buying the reversals, I'm buying the continuations, If the market shows a reversal, I'll start selling the reversal, I'll start selling the counter trade, right? So let's say the market is moving up. We're looking to, obviously, we've been buying. And then the market gets to a point, we're buying all these areas. And then the market breaks structure. Remember, this trend line has been intact. And this is like a daily chart. So this might be several months or several weeks of trading. And then the market breaks the structure. We are looking at a clear reversal, right? And then what then happens is the market breaks this level. We start looking for, okay, well, this is going to probably signifying that sellers are looking to come into the party, right? So we start looking to trade the market maybe on the opposite direction, maybe a retest of the trend line as new resistance. So in this case, we look to sell the market and play the new trend in this direction. So previously, we were buying these areas, buying this place. But when the market broke structure, we start playing the reversal trading where we're selling in the direction of the market. So it actually does involve whether you're swing trading or day trading, you need to understand the core concept of what kind of trader you are. And if you're if you're a technical trader, you have to be able to understand technical analysis and how this plays. Because the same concept on 1 hour chart is also the same concept on the daily chart. The only difference is it's a much bigger spectrum, a much bigger volume of data to work with. Now, the other type of swing trading that we look at is what we call the breakout trading. Now, breakout tends to occur after a period of consolidation in the market. So when the market has been, what I mean by consolidation is what we call ranging. Now, in my example here, I have the price moving in a more or less a horizontal, a flat surface. This could also be in a diagonal. So the market could be moving, could be consolidating in a sideways channel, just moving within a channel, but in a horizontal or a diagonal angle, right? So now, in a breakout, we have price moving within a range. Now, when market is moving within a range, it is what we call consolidation. And this range is never going to continue forever, right? At some point, this range will break. So as swing traders, we're looking to play, okay, so obviously, yeah, you could be looking to play this swing. This is also a swing trading setup because if this is a daily chart, you could be looking to play these swings, this high. But eventually, we know this market is going to break out one way or the other, right? So this is a range. The market is ranging. Now, when the market actually decides on what it wants to do, let's say the market decides to break to the top, in this case, which is a bullish example, I'll still show you a bearish case scenario now. And the market breaks this range. We then start looking for confirmation to buy the market because, well, this structure has broken. We want to play the next swing in the market, in this case, which is where the market moves upwards. So we're looking to play this breakout. This is what we mean by breakout. The market has been within this range and then, or respecting this zone, and then the market broke out. You can see the breakout, retest, and then the swing. So this is the area where swing traders will be looking to play the breakout, where the market breaks out on this section, we're looking to trade the market with this capturing this big swing. Because usually when the market consolidates like this, the breakout is usually big and strong. I'll show you one example currently, one I talked about to you guys in some previous trainings last in a couple of weeks on USD CAD as well. So this is something that it's quite interesting and quite, it's simple when you just play out the concept and pay attention or follow your own trading decision. Now let's look at the bearish scenario. So in a bearish scenario, the market is ranging, right? So we have the market ranging in this scenario because when the market is consolidating, it could break out one way or the other, right? So it could break out to the top or it could break out to the bottom. In the first example, I show you break out to the top. In this example, we're just looking at the same scenario, but they break out to the bottom. The market broke out from the range. We start looking to sell the market, on with confirmation to the downside. Now, they're just like whether you're trading retracements, you're trading whether you're trading retracements, you're trading reversals, or you're trading breakouts, you're obviously going to definitely apply strategies to your trading. So if you're trading retracement or reversal, you definitely want to probably apply your technical concept, whether you're trading structure break or you're trading price action techniques, support and resistance, all of those things. You still use them, you're trading, you're just using the structure of the markets to figure out what to do, right? I hope that is clear. Now, let us go to the chart and look at examples of what we're talking about. Quotes for the day: knowledge is not power, it's only potential power. Applied knowledge is what real power is. So let's look at the chart and see some examples. Okay. Okay. Whoa, these are trades. So I gave this trade on the client only group. I don't know if you took it, but this one has nicely gone on to hit our targets. This is where we enter the market. I gave this on the client only group. This is where the market hits. This is where we enter the market, and this was where our target. You can see how the market sliced through like water. So nice one there. That one is out of the market, and then it seems we're having a classic breakout. So if this breaks out, well, I'm looking to sell the market. If this holds, I'm looking to sell the market if we probably get a retracement back up. Now, let's look at our example. Now, Remember, as swing traders, we're working with higher time frame, right? So we're looking at the higher time frame. Now, there's nothing stopping you from being a combination of all, right? Personally, I'm a swing trader, but I also pay attention to intraday trading, mostly because, well, I have to give analysis to a lot of you guys, but I also trade intraday, right? Because I have the time on my hand. But if I did not have a lot of time, then I would have been just strictly a swing trader. But I'm mostly a swing trader. I just trade intraday as well. Now, quickly, let's look at an example of a swing. And it's in every time frame, every currency pair. I can use this one as well as an example. You could see, but let's look at something quite clean. I want to just use something you can see. So GBP USD is one where I can quite explain the concept I'm trying to talk about nicely. Okay, so so you can see this, right? This is, remember we talked about, so I can use this example to this particular chart to explain two of the scenarios, right? Or even all of the scenarios if you wish. So you have the market, this is a daily chart. You can see this market has been in this uptrend for a while. If you put here, you can see this is back in May 2020. So this is a daily chart. Each candle here represents a day of trading. So if you're a swing trader and let's say you see the market, you've seen this trend, you know, at this point, right? You've seen this trend at this point here. You've seen markets bounced off from here, bounced off from here, and then you have price coming down to this level, right? As a swing trader, you know, okay, very likely if the market respects this area, the price will at least go back to retest this high, right? Now, so what you do is, well, you start, when as price is approaching that zone, you start looking for confirmation. Now, confirmation is basically depending on your style, all of the things I've been teaching you, you start looking for price action setup, break of structure, trend line break, all of those things constitute confirmation. So in this area, we did have this rejection candlesticks here, tweezer, but we did have this, you could see this indecision candles here from level of support. On top of that, if we could draw, you could see that there's a counter trend line break, something like this. And so that could be your confirmation. Once you have that confirmation, you are buying the market here, right? You're targeting at least this high back here. Where will your stop loss be? Well, below here, right? Now, let me take off some of this drawing so you can see more of what. Now, remember, if we're looking to trade this swing, so this is what our trade would be like. Our entry, let's say we enter after the trend. Let's draw the trend, our counter trend line break. So we did have our counter trend line break like this, right? Like this. So let's say we decided to buy the market after the break of this trend, of that counter trend line. Our stop loss will come below here, right? And our take profits, let's say we're targeting this previous area. Now, look at this. We're looking at the daily chart. What is the difference? Remember, we're talking about the pros and the cons. The move, if the price goes against us, the number of pips from our entry to our stop loss is, let me just show you here, 152 pips. That is 152 pips risk. So this is why what I mean when I said in swing trading, because you're looking at a much higher time frame, the risk is, you know, bigger. You're looking at 150 pips plus risk if the market goes against you. What is our potential profit? Well, our potential profit in this case is over 590, about 600 pips of profit. So you see, we're risking here, but still apply proper risk management. You can see we're risking, our risk to reward ratio is solid, but we're risking just about 150, 160 pips. And we're looking to get 600 or 590 something pips, right? So even though it's a good risk to reward ratio, if you're not comfortable with this, this, and this is the reason why you need to use proper risk management, because if you over leverage, then this move here could just wipe out your account. And this is the reason why I said you need at least a sizable account. Or even a $100 account, you can still trade with the $100 account. You just definitely want to use a smaller account size, a smaller lot size, I mean. Now, so, but here's another pros, here's another, what I call it, cons or disadvantage, is the waiting period. Now, see our entry. We entered back in April, what am I saying? September 25th. right? And then when the price hit our targets, let's say this is where price is our target back in November 23rd. So from September to almost a month, just about a month that we are holding this particular trade for price to get to our target. So, another thing too is also, are you okay with this? Because, and then you have to be able to play out the swing. You could see that in between this, from our entry to where the market goes on, you could see the market, so, is moving. This in between swing is also something you also need to be able to weather down, right? So you could see that, at some point in the market, you're in profit. Next thing, it seems like you're losing the profit. It goes up, it seems like you're losing it. So these are some of the things that you also need to be able to weather down as well. Now, as a swing trader, you just, you set this, you've done your analysis. As long as this trend line holds. So as in this case, as long as this trend line holds, so if, for example, this trend line breaks, I probably will just close the trade. As long as this trend line holds, you're still in the trade, and then you play it out and you take your profits. Now, for a day trader, right? For a day trader, they could be trading these swings in that day, right? So they could be, so let me see if I could, let me just draw a rectangle to here, and let's zoom into this, this movement here. So let's look at this from here to this area. Now, in a swing trader, this is one trade, we're just looking to capture 600 pips. For a day trader, we're probably looking at maybe the 1 hour charts, right? Now, even though this is not a trading on day trading, I just want to show you the difference in, it's still the same concept would apply. As a day trader, we're still looking at the same concept, looking to trade based on sound technical strategies. But you can see this move. This is that box I drew, but on a 1 hour time frame. So for a day trader, you're looking to play these swings. You can see this, maybe you're looking to buy because of this pin bar, you're looking to maybe sell because of a pin bar, but you're trading these intraday swings, right? But for a swing trader, you're not concerned about the day to day. You're just, once the setup looks valid, once the setup is valid, you decide, you place your trade, and then you just walk away from your charts. And then it's just all about monitoring your chart every single day. See, for a day trader, there are a lot of candlesticks here. So if I use my measuring tool, I want to see there are how many candlesticks it takes to go from. We're looking at about 740 bars, right? Why for a swing trader, that's just a couple of weeks, right? Or in this case, a couple of weeks. In most cases, a couple of days as well, right? So that is the first example where swing traders are looking to trade the retracement, right? So retracement, market pulls back in the overall direction is bullish, and we are trading retracement. So you keep doing that. If you also miss the opportunity, this is also the market pulls back, you're playing the retracement. Again, the market pulls back to this zone here. Where's my brush? So you can have the market goes up, pulls back, right? And then this is a retracement. You can look to buy the market up to previous level, right? Now, so you see how this is. That is how it is when it comes to trading retracement. Now, for reversal, we know that the market was not continuing in a particular direction forever. In cases of reversal, we know, fine, we've been trading this, we bought, market goes up, market comes down, we buy again, market goes up, and then market comes down, we buy here again, right? Market goes up, we take profits. We've been taking profits here, taking profits here as well, and all through all this zone here. Now, look at what happens. Well, price comes back down again to the trend line, right? Now, I was anticipating this breakout. Reason being that the price failed to break above previous high, right? So that suggests weakness. Now, but let's just forget about that for a minute. Now, you see that price came back to trend line. In previous example, trend line held, the area held here, it held here as well. You can see that level held. Now, you see in this case, when price came to trend line, what happened? It broke. It failed to hold, and so it broke. Now, in this scenario now, as a swing trader, what it means is, well, I should stop looking for buying opportunities and start looking for selling opportunities. And so you can see in this case, price broke trend line, went up to retest it, and start moving downward again, right? You know, it's looking at it is like, well, it's just the patience to play out the trade, right? So now, as far as price is in this motion, and as far as price continues to stay constructive, as a swing trader, well, I'm only looking for selling opportunities, right? Now, if you're a day trader, obviously you can be looking for, you're probably playing in between the buys, lows, and all of those, maybe trying to trade the market based on the setup. But that being said, well, in this scenario, as a swing trader, you've gone from retracements to reversal. So you were looking for buying opportunities. Right now, you're looking for selling opportunities, and the market makes a new low, makes a new high. Well, you're looking to sell this high down. You know, as long as the market continues to stay constructive, you keep looking for selling opportunity until maybe the market breaks. Let's say the market breaks a trend line or something like that, or starts make structure shows weakness, and we see price break above, and then we start looking for buying. So it's a constant flux of going between buying and selling and buying and selling and buying and selling, right? So we want to pay attention to the trend in the market and how to play it. Now, last but not least, I think I've taken a lot of time, is to look at the example of what was the third example? Breakout, right? So a breakout usually occurs in, like I mentioned, when the market is consolidating. And in consolidation, the market is moving from side to side. Now, this is a good example here. You could see that the market here was moving from side to side. This was actually one of the reasons where I started selling the market up from, basically because of the breakout. So you could see how the market was not making much progress. We're just moving from side to side in this region. And then what happened when it broke out? You see that it has not broken out within this region here. It's never closed the day above or below this range. It was just moving within that region. And then when it finally broke out within that range here, you can see how the follow-up was a big swing in the market, right? So the market was moving from side to side, you know, playing this range up, down, up, down, up, down, you know, up, down, and eventually broke down, closed below that area. And then what happened? The swing low, right? So as a swing trader, you're paying attention to range like this. You're paying attention to it because you know the price will break out one way or the other, right? The market will probably give you clues as to which way it wants to break out, but you want to wait to see when it happens and how you want to play that out. And then this is where we get the confirmation. Then we take the trade the breakout way. Now, there's also a very fine example in USD card, one that I took hands-on quite nicely last week. Oh, this is beautiful. Okay, so you had this, I mentioned this range here, where price was trading within this range here. You can see how price was up, down, up, down, up, down, up, down, and break, right? So this is what we call a breakout, a cluster. Price is consolidating, and then after consolidating, we did have this confirmation of the breakout, and then we had this move up. So as a swing trader, this is a swing low. Right now, remember, we're now looking for buying opportunity. This is a pullback. This is a swing low. We're looking to buy this again, and we're looking to trade the market all the way up. So I hope I actually enjoyed teaching this. I hope you also got a lot of points as well from this. So that will be all from me for today. If you have questions, just quickly type in your questions. I'll answer as much as I can, and before I leave you for now. So I'm going to stop the recording of this and take your questions if you have any.